Hello and welcome. So we are going to discuss about chapter 6 fixed income security features and type in this recording. So let's start. So corporations and government need money for a variety of reasons. So it can be to finance future growth or to finance current operations. So example is if I'm running a corporation, I need money to expand. So to get into different product lines, to increase my production, to get into different geographical markets. So for each of these things, I need money. Also, I need money to finance my current operations. Example, paying employees my salary, paying executives their salary, then buying raw materials, financing raw materials. So everything long term as well as short term, I need money. Significant evolution in the market for debt and fixed income securities has happened. So many types have resulted out of it and features have increased a lot. Common characteristics with most fixed income security is payment of a regular income stream. So how does a typical vanilla fixed income security work? You purchase the security by paying par value or by paying price. So you purchase the security by paying price, you buy the security. The security at regular interval pays you interest in form of coupons, and when it matures it pays you par value or face value. So once again, you pay something to buy that security, that is called as price of the security. The security pays you coupons at regular intervals. Some securities may not, but most of them, the typical securities pays coupon at regular intervals, and when the security matures it pays you face value. A debt or fixed income security is a type of security that promises to pay the lender interest and returns the principal, returns the par value, and when it matures. The security may or may not be secured by a specific pledge. So specific pledge means if I'm issuing some bonds, I can have a specific pledge. So this asset that I have, I pledge it against the issue of the bond. So if I'm not able to service that bond, the bondholders can take over a specific asset. So that is called as a specific pledge, or it can be general pledge. So there is no specific asset that I have put forth, but the bondholders have general claim on my residual assets. The debt is typically outstanding for more than a year. So most of the fixed income securities have a period more than a year. So why is fixed income issued? So rationale is use of financial leverage. So use of financial leverage means if a company can invest in a project that earns more than the cost of funds. If a company can invest in a project that gives returns more than the cost of funds, then there is financial leverage. So it will add value to shareholders. Example, if I'm running a project and I expect my return on investment to be 9%, and to start this project I fund money by raising bonds at 4%. So I'm going to get 9% rate of interest or rate of return, and I'm going to pay 4% to my bondholders. So in this case I would have a financial leverage. So my equity holders would benefit because return is more than the cost. So companies do this, do bond issues to take benefit of financial leverage. They also do bond issues to finance growing opportunities. So growing into different products, means increasing the capacity of production, getting into different product lines or getting into different geographical markets. Most of it is funded by debt issue. Bond versus debentures. So bonds are fixed income because they imposed fixed financial obligation on the issuer. It is secured by physical assets. So important thing, they're secured and they're secured by physical assets. So physical assets means a particular factory, a particular raw means inventory of raw materials, or it can be, let's say, if infrastructure company, a bridge or a railway cart, etc. Details of bond issues are given in the trust deed. So this is important. All the details that you see in the bond, it's given in a particular paper called as trust deed. And the bond contract, if the bond defaults, bondholder can seize specific assets. So this is important. So since specific assets are pledged, if the company defaults on the bond payments, bondholders have a direct claim on specific assets. A debenture is a type of bond that is secured by something other than a specified physical assets and sells them to recover their investments. So debenture is not secured by a specific assets, it is secured by something else. Generally it is backed by general creditworthiness and called as unsecured bonds. So how does it work? So to conceptualize it, take an example of housing loan and a personal loan that a person generally takes. So housing loan, in case of housing loan, you have a collateral in form of your house. So if you don't service the loan, if you don't pay back the loan, the bank, the issuing financial institution, will take over your house, will foreclose your house. But in case of personal loan, they may sue you, but there is no specific asset that is attached to you. So they would have to go to the courts and then sue you for money, right? So this is the difference. So bonds have a specific assets, debentures do not have a specific assets, they have a general claim. And it doesn't mean that debenture holders are not paid. So if the company is closed down, everyone is paid, bondholders are paid because they have specific claims, and whatever money is left, that goes to the debenture holders. So it doesn't mean that debenture holders are not paid. And another difference is sometimes debentures are also called as bond. So though they do not have any specific asset, but because of the street language or the street term, we call everything as bonds. Example, most of the government issues are debentures, they are not bonds, because government does not pledge specific assets. So it's a general claim against government, but still government debentures are also called as bonds. Now bonds have certain characteristics. So they have coupon rate. So it is expressed as a rate of interest income paid by the issuer, typically fixed for the type of the term of the security, and some bonds may pay variable coupon rate. So important thing to note, coupon rate is the percentage payment that you get each year, right? Coupons are always paid as always expressed as a percentage of face or par value. So if par value is $100 and coupon rate is 2%, you are going to get $2. This is how it works. So coupon rates are always expressed as a percentage of par value. In North America, most of the bonds pay semi-annual coupons. So every year, for every 6 months, you get coupons. Face value or par value is the principal amount that is returned back to you when the bond matures, generally expressed as in 100 or in 1000. Term of maturity, the remaining life of the bond. Maturity date is the date at which bond matures and the principal is returned to bondholders. Bond price, it is the present value of all discounted cash flows you're going to get, price you pay for the bond. So bond price is present value of everything you're going to get from the bond. So what are you going to get from a bond? Two things: the future coupons, and when it matures, the principal, that is the par value. So bond price today, the price that you pay today, is present value of those coupons and present value of the principal. Now sometimes if par value is $100, the price that you pay today may be $98, $100 or $105. If it is 98, that is the price that you pay is less than the maturity value, in which case you would get a capital gain because you're paying 98 and you are getting back 100. So there is a capital gain. In that case, bonds are called as discounted bonds because you're paying less than the face value. In second case, if you're paying 100 and you're going to get back 100, so there is no capital gain, there is no capital loss either. So in that case, it is called as par bonds. So they are issued at par, right? In the third case, if you're paying $105 and you're going to get $100 back, in that case you're having a capital loss. You may recover it through the coupons, but right now there is a capital loss. You're paying 105, you're getting back 100. In that case, it's called as premium. So discounted means they're issued less than face value. Par means they're issued at face value or par value. And the third case, premium, means they're issued above par or face value. Next is yield to maturity. Yield to maturity is the annual return on the bond that is held to mature. So the rate of return you get from a bond if it is held till maturity. Yield to maturity is composed of two elements. One is capital gain or loss, that is what you pay, what you get, and the coupon payments. So yield to maturity is combination of capital gains and losses and the coupons that are paid to you. Characterizing bonds by term. So bonds can be money market, so up to 1 year in terms of maturity. Short term bonds 1 to 5 years, medium term bonds 5 to 10 years, long term bonds greater than 10 years, and generally bond flows. So what happens, there is a long-term bond, so let's say it's a 30-year bond, then it goes through midterm, then it goes to short-term, and finally it goes to money market. So money market generally composes of T-bills and government issues, but sometimes good companies that have good financial backing, if their maturity is less than a year, they are also traded in money markets, right? So this is important. Bonds do not always remain long-term. As they keep on maturing, they go from long-term bonds to a short-term bond. Now interest rates on bonds, coupons are generally fixed, but there are some variations. So you can have a step-up bond. Step-up bond means after a particular time interval, the interest rate or the coupon rate increases. So you may have a bond that is issued at 5% right now, but 3 years from now, the coupon rate changes to 5.5%, then it changes to 6%, etc. So interest rates keep on changing after a particular interval. That is why they are called as stepped up bonds. Next is zero coupon or stripe bonds. So zero coupon bonds do not pay any interest in terms of coupons. Interest is built into the price. So only gain that you make from a zero coupon bond is difference between the price you pay and the price you get and the face value you get. Example, if it is a 30-year zero coupon bond, you may pay $600, and when the bond matures at the age of 30, after 30 years, then you get back $1,000. So your gain is $400, but the gain is not paid until the bond matures. So there is no regular coupon payments. Then there is index linked note. So index linked note means there is some part that is guaranteed. So some interest rate that is guaranteed, which is generally very low, and you participate in the stock market returns. So your money is invested in an index fund, and as the index goes up and down, the stock index goes up and down, your return is variable. Now bonds have three characteristics: liquidity, negotiability, and marketability. Liquidity means how easy it is to trade the bonds. So liquid bonds trade in significant volumes. Example, Government of Canada bonds are highly liquid because it has large domestic as well as international demand. So there is a big marketplace for it. So liquidity is very high. But let's say XYZ company's bond may not be liquid because no one wants it. So there is no demand and supply for it. Negotiable bond means they can be transferred. So not applicable now, as most of the trading happens online. So most of the bonds are transferable because it's an electronic entry. But in earlier days, it was traded in a piece of paper. In that case, some bonds were non-negotiable. So they were always were issued in the name of the bondholder. But right now it is just a change of electronic entry. So they are very easily negotiable. Marketable bond means that they have a ready market, if that is they're easy to sell. So there is a good demand for these bonds. Some other features: callable bonds, they are redeemable. Issue, how does redeemable work? So there are two players: the bondholder who buys the bond, and there are issuers. These are companies who issue the bond. Most of the bonds are callable bond, means the issuer, that is the company, has an option to pay the bondholder a certain amount of money and close the debt obligation. It means, let's say it's a 30-year bond, but it is callable after 5 years. Means after 5 years, if the company wants, it can pay a certain amount to bondholders. Let's say it is $1,020 on a face value of 1,000. So it can pay in $1,020 and close the debt. So bondholders will get that 1,020 but will not get any future coupon payments. Okay. So issuers may pay bond off, that is call it in, before maturity. Depends on behavior of market interest rate. So generally companies call bond when market interest rate go below coupon rate. So if company has issued a bond at, let's say, 9%, but the interest rate right now is at 2%. So what the company can do, pay off the debt that is extremely high, that is issued at an extreme high interest rate, and issue a new debt at 2% rate. So companies generally calls the bond when interest rates are lower than coupon rates. Call price is typically set above the par value. So price that the company has to pay is generally more than the face value of 1,000 or 100. Premium seen as a compensation for being called before maturity. Premium decreases as per maturity. So what does this mean is, if the company calls it at 5 years, it will pay, let's say, $1,100. If it calls after 10 years, it will pay $1,050, and if it calls after 15 years, it may not pay anything, so it will pay just $1,000. So the amount that the company has to pay to call the bonds keeps on decreasing as the time matures. You may get accrued interest when the call is when the bond is called. So you get accrued interest also. Accrued interest means the day the last coupon was paid till today when the bond was called, whatever interest is due, the company has to pay that interest. So company pays call price plus accrued interest on each bond, until and unless there are provisions of not doing that. Now, callable bond was an option to the issuer. Extendable debt and retractable bond are an option to the bondholder. So bonds that are issued with short-term maturity but with an option for the holder to exchange the debt for an identical amount of long-term maturity at the same interest rate or at a higher interest rate. So what it means is, I have bought a 5-year bond, but after the end of 5 years, I may extend that bond for the next 10 years by exchanging my bond with a 10-year-old bond at the same interest rate or at higher. So I get to extend my debt. I get to extend my bond as a holder, not as a company. Retractable bonds are issued with long-term maturity but with an option for an investor to turn the bond in for redemption before the maturity. Retractable are opposite to callable bond. Callable bond and retractable bond are same. Bonds are paid off before maturity. But in callable bonds, issuer decides it. In retractable bond, the bondholder decides it. all these decisions are made in election period. So election period is decision to extend or retract the bond has to be made within a specified period. The next is convertibles. So it's a two-way security or a convertible pledge. Combines the advantage. Convertible means you can exchange your debt for equity. So I am buying a convertible debenture or a convertible bond. So after a certain time, I can exchange my debt with equity. So when I exchange it, I get to be a part in the company's growth because of equity, but I lose out on the interest or the coupon payments that the company was paying me. So combines the advantage of a bond with option of exchanging the bond for common shares. With the conversion privilege, the holder has an opportunity to participate in capital appreciation of underlying shares. The feature makes issue more attractive and more saleable. Bondholders must be aware of forced conversion clause. Sometimes the companies have a forced conversion clause. So even if you don't want to convert, they would ask for a conversion. So you have to be beware of that. Characteristics of conversion. Conversion price goes up over time. So let's say if you convert it in 5 years, the conversion price is 20, it may go to $25, it may go to $30. So company wants to, conversion price is nothing but what you pay to, effectively what you pay to convert, right? So after 5 years you may effectively pay $20. After 10 years you may effectively pay $25. So price is going up. Why? Because company wants you to incentivize you to convert early. So they want lesser price initially than at later date. Some may have a clause not to pay any interest or dividend. So there is no accrued interest or dividends in conversion. Protection against dilution. So most of the conversions are adjusted for stock splits. Forced conversion. When does the company ask for forced conversion? When the market interest rate is below the bond's coupon rate, and when the price of underlying common share begins to trade above the conversion price. So two cases it can ask for a forced conversion: when the interest rate on the bond, interest rate in the market is less than the coupon rate, or when the price of the bond is above the conversion price. Behavior of convertibles. So they act like a bond and they act like a common share also. How? When the price of the underlying stock is below the conversion price, they act like a bond. So when the price is below conversion, there is no benefit out of conversion. So they act like a bond. When the price rises above the conversion price, the bond price rises accordingly. So they act like a share. So when the market price of the share is above conversion price, they start acting like an equity. When the interest rates rise significantly, so they have a precaution. They have a certain limit. So how does it work? When the interest rate rise significantly, when interest rate goes up, bond prices fall. But in this case, the bond prices do not fall below the conversion price. So there is a protection set in. So when the interest rate rises significantly, even then the bond will not drop below the conversion price. So three aspects. Bond acts like convertible bond acts like a normal bond when the price of underlying stock is below the conversion price. It acts like a share, that it rises in value when the price of the share is above the conversion price, and they have a precaution. So even if interest rates rises significantly, bond prices will not fall below the conversion price. The next are these two concepts, sinking fund and purchase fund. So how do these two work? So each year from the earnings, the company puts aside a certain fund, and these funds go into a account called as sinking or a purchase fund, and these accounts are used to pay back debt. So both sinking fund as well as purchase fund are used to pay off debt. How is the money accumulated? Each year from earning, a certain amount of earnings is set aside, and these earnings go into these accounts, sinking and purchase. Now the difference is, sinking fund tries to buy the debt that the company has issued in open market if it is below a certain price, but if it is not able to buy that debt, it will issue a call. It will issue a call option, right? So it will call the debt back. Now, first thing you have to remember, calling the debt is generally more expensive than buying debt in the open market below a certain price, right? So sinking fund has an obligation to retire the debt no matter what. It will try to buy it in open market, or if it cannot buy it, it will issue a call option. Purchase fund doesn't issue a call option. It will try to buy the debt from open market if it is beneficial. So just to summarize, a company from its earnings each year contributes some part to sinking or a purchase fund. Both these funds are used to pay off debt, already issued debt. Sinking fund has an obligation. It has to pay off debt, a certain percentage of debt. It tries to do it by buying the debt in open market. If not possible, it will issue a call option, which is generally more expensive. Purchase fund doesn't issue a call option. It tries to buy the debt from open market. So obligation is more towards the sinking fund. Purchase funds do not have much obligation. So sinking fund is more binding. Purchase fund is not so binding for a company. So sinking fund, sum of money which are set aside out of earnings each year to provide for repayment of all or part of the debt issued by maturity. Calling them on fixed schedule of dates. So tries to buy in secondary market below the market price, else will issue a call option. A fund set up to retire a specified amount of debt outstanding or debenture through purchase in the open market only if it is beneficial. So if the purchase made are at or below a stipulated price. So sinking fund is much more binding than a purchase fund. Now, whenever a bond is issued, there are certain protective provisions that are in place for the protection of bondholders. So let us go through what different provisions can be there in a bond issue. It may mandate a certain security. So certain assets have to be pledged to issue a debt. Negative pledge means the assets that are already issued as a security cannot be pledged otherwise. So you cannot double pledge a particular asset. So you are stopped from pledging the assets that are already pledged for a bond issue. Okay. You may have certain limitations on sales or lease back transactions. So you cannot sell the asset or lease them when they are as a collateral for debt issue. Sale of assets or mergers. So certain companies have a provisions against merger. So if a company is getting merged with other company, the new company has to honor the previous debt, so has to take it on its balance sheet, or it has to pay the debt back. So there are protections against merger. Dividend test. So certain provisions stop companies from paying excessive dividend so that the earnings are not diluted. So the equity proportion is not extremely diluted. So it stops from paying excessive dividends. Debt test. So there is a debt to asset ratio test. So you cannot have extensive debt issued beyond a certain percentage. So that can be a protective provision. Additional bond provisions can be there, and you may call for sinking or purchase funds as well as call provisions. Next is types of bond. So types of bonds are marketable, Canada and provincial bonds. So these are majorly marketable and transferable. They are issued by the federal government or the provincial government. You have treasury bills. These are short-term issues maturing before a year. do not pay any coupon. So only gain you make in treasury bills is difference between purchase price and the par value. Canada savings bonds, so these were discontinued in 2017. So it majorly started with the world wars and they were an instrument to raise money for our war efforts, but because of lesser popularity these have been discontinued slowly. Real return bonds, so important point, real return bond means the bond pays an inflated adjusted return to the bondholders. Bond pays an inflation adjusted return to bondholders. Now both the things, coupons as well as the maturity amount, is inflation adjusted. Okay. Provincial saving bond, so these are issued by provinces, can be purchased only by provincial residents, purchased only during a specified time of the year, and they are guaranteed bonds of provision corporations also. For example, Ontario Electricity, the department agency, can issue certain bonds which are guaranteed by the province of Ontario. Installment debentures or serial bonds, so these are generally municipal bonds. Part of the bond matures each year during the term. Treasury bills features offered in 1,000 increments. Terms are 3 months, 6 months, 1 year. Do not pay any interest. They are sold at discount and mature at par. Difference between purchase price and par is the rate of return. This return is taxable as income and not as a capital gain. Canada savings bond issued by the federal government must be sold back to the government. No secondary market trading is there. Market values are not affected by the changes in interest rates. They are redeemable in par. Canada savings bond are only sold through payroll savings program and are available only to Canadian residents. Corporate bonds now. So we have seen government bonds. Now let us see corporate bonds. Mortgage bonds. These are secured by pledge of land, building or equipment. Collateral trust bonds. So these are not secured by physical assets. They are secured by a pledge of securities. Collateral trust bonds are generally issued by the holding company by pledging the securities of the subsidiary companies. Equipment trust certificates secured by equipment, for example railway cars. Subordinate debentures, these are junior to other securities. So subordinate debenture means that these debentures have the last claim on all the assets, so everyone else is paid in terms of debt and then these debentures are paid, so they have a subordinate claim on assets. And then we have high yield bonds. So these are issued by not so credit worthy companies. They are also called as speculative bond, but they pay very high rate of returns. Next is floating rate securities. The interest rates on these securities are adjusted to the market interest rates. So if interest rate goes up, these bonds pay more. If interest rate falls, these bonds pay less. Corporate notes rank behind all fixed income securities of the issuer, so they are paid last. Strip bonds do not pay any interest, separate coupon and principal of high quality bond. So an investment bank generally strips the bond, so they separate the coupon payments and they separate the maturity payments and sell each of these separate payments as a new bond. So this is called as bond stripping process. So take a high quality bond, strip each of its payments, so separate each of its coupon and the maturity payment and sell these payments discounted separately, make them zero coupon. Okay. Preferred securities, these are long-term subordinate debentures and foreign bonds and euro bonds issued in the currency or country other than the issuer. So there are three types of foreign and domestic issues. Domestic bonds, bonds denominated in the currency and the country of issue. So a Canadian company issues bonds in Canada in Canadian currency, in Canadian dollars. So these three parameters check, then it's a domestic bond. Foreign bonds, bond issued outside the issuer country and denominated in the currency of foreign countries where it is issued. Example, a Canadian company issues bonds in America in American dollars. So two are checking. Country is America and it is issued in American dollars, but it's not an American company. Then it is called as a foreign bond. And if all three are different, then it is called as a euro bond. So bond issued in a foreign market and denominated in a currency other than the market where it is issued. So a Canadian company issuing bonds in America, but it is issuing in euros instead of dollars. So all three are different. It's a Canadian company, issues it in America and issues it in euros instead of American dollars. Then it is called as a euro bond. Example, a Canadian company issued bonds denominated in Japanese yen in the Japanese market. It will be called as a foreign bond. Bonds issued by Canadian companies or government in Japan, but they are denominated in US dollars. So Canadian company, Japanese market, American dollars, all three are different, then it's a euro bond. So issuer is Canadian, issues in Canada, Canadian currency domestic. Issuer is Canadian, issues in Mexico, but in Mexican pesos. So two are checking mark, foreign bonds. Issuer is Canada, issues in France, but in US dollar, euro bond. Canada, European markets, Canadian currency, it's euro bond. Canada, US currency, it's a foreign bond. So if two are check-in, it becomes foreign. If three are different, it becomes a euro bond. And if all three are same, it becomes a domestic issue. Other types of fixed income, bankers acceptance. Generally how it works is banks guarantee the maturity payment. So a company issuing bankers acceptance generally issues it at a discount. So you pay $900, you buy that bankers acceptance. After 1 year, you get back $1,000 from the bank. Commercial papers, these are short-term money market instruments issued by companies, generally less than a year. Again, same way, discounted from the face value. Term deposits issued by banks, so blocks your money for a particular duration and pays interest on it. Guaranteed investment certificates, again majorly issued by financial institutions and blocks your money and you get interest payments. Now there are different forms. You have escalating rate, so rate keeps on increasing. Laddered, the rate increases but after a particular period. So 5 year the rate remains constant, then it goes up for next 5 years, then it goes up for next 5 years. So same like that. Installment, so you buy the bond by paying lump sum and then you make regular investments. Index linked, so index link means that you get a minimum interest rate from the bond that is fixed, plus you get your money is invested into stock market and you get stock market returns. Interest rate linked, so it changes as per the interest rates in the market. Other ways to invest in bonds, you can have a fixed income mutual fund or exchange traded fund. So you can indirectly invest rather than directly buying bonds and debentures, and it's a very decent way because then you have a professional management team that is handling your investments. So bond codes look like this. So the company name, this is the coupon payment, 11.5% is the coupon. Maturity is on June 1, 2000, let's say 30. This is the bid price, this is the ask price. So if you're buying, you buy it at this. If you're selling the bond, you sell it at this. And 11.75 is the yield to maturity. So it composes of the coupon as well as difference as well as the capital gain that you encounter. So that's it for this recording. We'll catch up in the next class. Hello and welcome to this recording. In this chapter 7, we are going to discuss fixed income securities, pricing and trading. So highlights of this chapter are: most bonds and fixed income securities trade in the market on the basis of their yield or yield to maturity. So understanding what yield to maturity is very important. Changes in interest rate play an important role in pricing of bonds and fixed income securities. the fair price to pay for a bond or a fixed income security is a function of current interest rates, the term to maturity, and the coupon or income component on the security. So things that are important: interest rates impact bond. Interest rate or understanding yield to maturity is important, and the price that you pay to buy the bond, it's dependent on the coupon it pays, the interest rates in the market, the maturity time that is left on the bond, and what is the reinvestment risk that is based on coupon. So we'll discuss all of that. So little bit of time value of money. Bond price that you pay is always present value of future coupons and the maturity value. Present value of the maturity value. So it has two components: present value of future coupons and present value of the maturity amount. So what is present value? It is used to determine value of the bond. How much should be invested today to receive the face value of the security in future? So it is sum of present value of bonds cash flow that determines what you should pay for the bond today. So formula for present value is equal to future value divided by 1 plus discount rate R to the power n. So some practice problems before we get going. So what is the present value of 1040? What is the present value of 1040 to be received in 1 year's time with a 4% discount rate? So you, in your calculator, when you solve, there are 5 variables. Okay, so we'll be using calculators to solve it. So I'm starting an Excel. Okay, so 5 variables in your calculator is n per, that is n, rate, in calculator it is I by y, this is n, then there is interest, then there is PMT, PV, FV, and you can have your calculator in set end or set beginning mode. Okay, so when you solve for bond calculations, so we'll discuss bonds, then we'll come to the problem. When you solve for bond calculations, most of the bonds are generally semi-annual unless and until it is given specifically in the question that they are annual bonds. So what do you have to do by default is, whatever n is given, you have to multiply it by 2. So as n is expressed in semi-annual terms, rate also has to be expressed in semi-annual terms. So you have to divide the rate by 2 unless and until the bond is annual. It is given explicitly that the bond is annual. Next, your PMT is always mentioned as a rate, coupon rate. So coupon rate, the coupons that you get are coupon rate multiplied by face value or par value divided by 2. Again in semi-annual, present value is what you calculate, future value is the par value or face value, let's say 1000. And important thing is, bond calculations are always done in the end mode. So for calculating bonds, always we use end mode. Okay, so once again, whenever you are calculating questions about bond, whatever n is given, it should be multiplied by 2 unless and until the bond is annual. Rate divided by 2. Coupon rate should be PMT, you find out by coupon rate multiplied by future value divided by 2. PV you have to calculate. Face value is given, face value or par value is given. Signs are important. PMT and face value should have same signs. And by default, bond calculations are done in the end mode. So coming to this problem, present value of 1040 to be received in 1 year's time with a 4% discount rate. So 1 year's time, future value is 1040. They haven't given any PMT. The PV we have to calculate. They haven't given any PMT, and the rate is 4%. So if you calculate PV, it's a rate, but since the bond is not, means it is not given to be annual or semi-annual, so we'll just consider it annual right now. NPER is 1, PMT is 0, future value 1040, and type doesn't matter unless and until there is PMT. So the value of this cash flow is 1000. Present value of a 1 year bond with 1000 par value, 4% paid annually it is given with a 6% discount rate. So things that are changing: 1 year face value is 1000, coupon payment is 4% annually, so it is 4% multiplied by 1000, but it is annual, so I am not dividing it by 2, and the interest rate is now 6%. So if you go to this function, PMT is missing, so it is 40, and the face value that they have given is 1000, not 1040. So it is 981.13. Okay, value of a 1 year bond with 1000 par value, 4% coupon paid annually, and 2% discount rate. So if you just change this to 2%, the value change. Okay, so this is the solution for it. Now this is important: 8% coupon rate, semi-annual bond, 10,000 par value, and 6% discount rate. Now this is important, and it will be 2 in this case because it's semi-annual. So 1 year has 2 semi-annual, 2 half months period. Discount rate is 6%, so 6% divided by 2 will be our rate. Coupon rate is 8%, so it will be 4% multiplied by par value. So 4% how did I get? So I did 8% divided by 2 multiplied by par value 10,000, so 400. PV we have to calculate. Par value is 10,000, so PV will be, rate is this, and per this, PMT this, future value this, type 0, always in end mode. So this is the answer. This is the value of the bond. Okay, so if you want, you can pause the video and try it, and then we can solve it together. So what is the present value of a semi-annual 9% 4-year bond with a par value of 100 and a 10% discount rate? So semi-annual 9% bond with a 4-year period. So 4-year means period will be 4 multiplied by 2. Coupon rate will be 9%, divided rate of discount will be 10% divided by 2. Coupon rate will be 100 is the par, 9% is the coupon, so 9% divided by 2 multiplied by 100, and par value is 100. So if you calculate, the answer to this is 96.7. Same with this question. What is the present value of a 8% 6 years bond? So 6 years is 6 multiplied by 12. N will be 6 multiplied by 2, that is 12. The rate of discount rate is 6%. Divide by 2. So I forgot to divide by 2. Coupon rate is 8%. Divide by 2 multiplied by 10,000. And the par value is 10,000. So the answer is $10,995. Okay. Now in the last module we have discussed what is T-bills. So T-bills are money market instruments that are issued from discount to their par value. So they don't pay any coupon. So they are discounted for the par value when they are issued. So only gain you make is difference between par value and the price you pay to buy them. For example, let's say you buy a 180-day T-bill at 96. So what is your gain? Your gain is you have paid 96, but you're going to get 100 when it matures. So difference, that is $4, is your gain. Okay. So they pay no coupons. The interest rate is built into the price. Now the yield is annualized term. Yield is always annualized. So the yield calculation that you are seeing here is annualized. The reason why we annualize it is so that we can compare. So formula for yield is 100 minus price divided by price into 360 divided by term into 100. Price is what you pay to buy the bond. So how much are you gaining and in what duration are you making the gain? This is the explanation for the formula. Okay. For example, they have given 181 day T-bill is purchased for 98,000. Now 98,000 means everything should be brought in the multiple of 100. So 98,000 will be 98, because if 98,000 is the price you pay, so face value is 100,000. So if you just scale it in 100, it will be 900 minus 98 divided by 98. Term will be 365 divided by 181 into 100. So let's do it. So 100 equals to 100 minus 98 divided by 98 multiplied by, so I'll put brackets so that it's easier. This entire thing multiplied by 365 divided by 181 into 100. So 4.11% is the yield. The second is what is yield on a 90-day T-bill purchased for 99. So in this formula it will be 100 minus 99 divided by 99. I'm putting the brackets. Multiplied by 365 divided by, it was a 90-day bill. So the yield is 4.09. So it helps us to compare different maturity T-bills. Okay. Next is calculation for the current yield. So the current yield is the short-term measure of return. It allows investor to compare investments in bond with other short-term instruments. It is the dollar amount of coupon you are getting divided by the current market price. So there are two rates that are there. One is the coupon rate and one is the current yield. So I'm telling you the difference. Coupon rate, the formula for that is coupons that you paid divided by par value. Now current yield is different. If you see the formula for current yield, it is coupon rates, the coupon that you get divided by price that you pay to buy. Okay, so this is the difference. We divide in coupon rate by par value and we divide in price that you paid for current yield. So it is the actual interest income rate of return compared with coupon rates earned on the bond based on the prevailing bond price and the market interest rate. So current yield in different cases, you have a 10% coupon rate bond on $1,000. So how much coupon are you getting? Coupon that you are getting is 10% multiplied by 1,000, so $100. And if you purchase the bond for 1,000, for 900 and for 1,100. These are the different price combinations that are given, purchase price that are given. So first case, the current yield will be coupon rate divided by 1,000, that is 10%. This is the current yield. Okay, in the second case it will be 100 divided by 900 and 100 divided by 1100. So the yield are 10%, 11% and 9% respectively. Important thing, sometimes 90 is given but the par value is 1000, so you have to scale it to 900. 110 is given, so you have to scale it to 1100. So they have calculated it. Next is YTM, the most popular. So YTM is the most popular measure of yield in bond markets. YTM shows the total return you would expect to earn over life of a bond starting today, assuming the coupons are reinvested at. So reinvestments are important. YTM calculation always assumes that the coupons that you are getting are reinvested back into the bond. It reflects the investor's return in the form of coupon income, capital gains or losses, and receiving par at maturity. The best way to solve for YTM is using a financial calculator. So we'll solve it. So calculate YTM with a 10% annual coupon, 1,000 par value and 10 years to mature. So let's do it. The bond given is annual. So what all is given? N is given, PMT is given, PV is given. PV is the price that you pay. Future value is given. You have to calculate the rate, that is YTM. So 10% annual coupon on 1,000 will be, PMT will be 10% multiplied by 1000, that is $100. Please note I'm not dividing it by 2 because it is explicitly mentioned that it is an annual coupon. If it is not mentioned, you divide it by 2. N is given to be 10 years to mature. PV is different in each case, and future value of the bond is 1000. It's a par bond, 1000. So signs are important. In the first case, PV is given to be 1000. So you are buying this bond at par, that is at 1000. So if you calculate rate of return, it would be N per PMT, PV, FV, and type of a bond is always 0. So yield is 10%. In the second case, if you purchase the bond at 90, so if you scale it in terms of 1000, it will be 900. Yield would be N per 10, PMT 100, PV 900, and FV 1000. Type is 0, so 12%. In third case, you're buying the bond for 1110, that is 1100. Please don't forget to scale it. Future value is in terms of 1000, so everything is in terms of 1000, though it is expressed as 90 and 110. So rate N per is 10, PMT is 100, PV is this sign I'll change, future value is 1000 and 0, but I have to change the sign for it to calculate. So 8%. So you would have noticed something with current yields as well as yield to maturity. So if bonds are bought at par, it means if, for example, face value is 1000, par value is 1000, and you buy it at 1000, then current yield equals YTM, yield to maturity, which again equals the coupon rate. So it is exactly coupon rate that what you are getting. Then if bonds are bought at discount, that is you pay $900 for $1,000 bond, then current yield and yield to maturity are greater than coupon rate. So you have to remember this function. If bonds are at discount, YTM and current yield are greater than coupon rate. If they are bought at premium, that is you pay $1100 for $1,000 bond, then current yield and YTM are less than coupon rate. The reason is, if you buy it at discount, addition to coupons, you are also going to get a capital gain. So you bought at 900, you get back 1000, so that's a capital gain. If you buy it at premium, So you'll get a capital loss. You bought at 1100 and you got back 1000. So there is a capital loss. So that's why yield is less than coupon rates in this case and yield is greater than coupon rate in this case. So this equation is important. You pause it, you note it down and remember it for the exam. So they have shown the calculations for it that we just did. So rules: if bond sells at par, coupon rate equals to YTM equals to current yield. If bond sells at discount, YTM and current yield must be greater than the coupon rate because of the capital gain. If bond trades at premium, YTM and current yield must be less than the coupon rate. Next is bond pricing properties. So bond prices move inversely to bond yields. So if interest rates or yield to maturity is going up, bond prices go down. If interest rates are coming down or YTM is coming down, the bond prices go up. Then longer the term to maturity, greater is the price fluctuation. Bonds with higher coupon move less than bonds with lower coupon. So higher coupon bonds are less sensitive than low coupon bonds. Special features leads to different pricing like convertible bonds. Bond prices are more volatile when interest rates are low than when interest rates are high, and bonds are subject to reinvestment risk. Except zero coupon bonds. Zero coupon bonds do not have any reinvestment risk. And there is a concept of duration. So you will see this one by one. So holding maturity is constant. You can make more money with a 1% decline than you lose with 1% increase. So what does it say? Bond with higher coupon move less than bonds with lower coupon. Example, if a bond has 10% coupon rate and a bond has a 15% coupon rate, and if interest rate changes by 1%, this bond that has 10% coupon will react more. So bonds with lower coupon are more sensitive. So longer the term to maturity, the greater the price fluctuation. So the two similar bonds, one is 15 years bond, one is 25 years bond. So longer the term, more would be sensitivity. So bond B is more sensitive. So 21%. Reinvestment risk is, since the interest rate fluctuates, the interest rate prevailing at the time of purchase is unlikely to be the same as the interest rate prevailing at the time of investor reinvest cash flows from each coupon. So it means whatever coupons you are getting, you may not be able to reinvest it at the same interest rate that was there when you bought the bond. Now reinvestment risk is zero for zero coupon bonds because they don't pay any coupons. So there is no question of reinvesting. Reinvestment risk increases if the coupon payments are high. So longer the term to maturity, the less likely it is that the interest rate will remain constant over the term. The risk that coupons cannot be reinvested at the time interest rates that prevailed on the bond is called as reinvestment risk. Duration measures the sensitivity of the bond. So it combines maturity as well as it combines the coupon factors. So it means how much will the bond change for a 1% change in interest rate. Higher the duration, more risky is the bond. So it is a measure of sensitivity of a bond's price to changes in interest rate. It is the approximate percentage change in the price or value of a bond for a 1% change in interest rate. The higher the duration of the bond, the more it will react to interest rate change. So higher the duration, risky is the bond. Duration is used to determine the volatility or riskiness of the bond or the bond fund. So if what does duration mean? So if the duration is 10, then the price of bond will change by 10% if the interest rate changes by 1%. So assuming you hold a 5% coupon bond that is currently priced at 1104. So if interest rate changes by 1%, the bond will fall to 93.60. So it reacts by 10%. So the term structure of interest rates, it is the general level of interest rate at any particular time. So the level of interest rates differ according to the maturity. So different maturities have different interest rates. One thing is important, the real rate of return, it is nominal equals real plus inflation. So in recession, the real interest rate falls. In expansion, the real interest rates rise because of the changes in inflation. Now this is important, the yield curve. So what is a yield curve? So yield curve is a graph. So I'll show it to you on yeah. So I'll show it to you on in. So this is a typical example of a yield curve. So it has period of maturity and the interest rates. It has period of maturity of bond versus interest rates. So it means the longer period bonds have higher interest rates than the shorter period bonds. So if it's a 30-year bond, it will have higher interest rate than a 6 months bond. That is what a yield curve or a term structure means. So these theories suggest why the shape of yield curve is the way it is. Now yield curve can be positive sloping, that is upward sloping. It can be downward sloping, that is negative sloping, or it can be flat. Positive, downward and flat. So based on the shape of the yield curve, there are three theories. So one is expectation theory. The expectation theory says that the yield curve is an indication of future interest rates. So if the yield curve is positive sloping, that is upward sloping, interest rates are going to rise in future. If the yield curve is flat, it means the interest rates are going to stay same. And if the yield curve is downward sloping, it means the interest rates are going to fall. Liquidity preference means the shape of yield curve, the upward positive shape of yield curve indicates that there is less liquidity in a 30-year bond versus a 6 months bond. So it says, first point, shorter term bonds have more liquidity. So for convincing investors to lock their money for longer durations, the long-term bonds has to pay more. So liquidity preference theory suggests that we have to pay more in long-term bonds to induce investors to invest there. That's the reason interest rates on long-term bonds are higher than the short-term bonds. The limitation of liquidity preference theory is that it doesn't explain flat curves as well as downward sloping curves. Market segmentation means the interest rates that you see on the yield curve is a function of demand and supply. So if demand is more, the interest rate go up. If supply is more, the interest rate go down. Second point, it suggests there are two different markets in terms of yield, in terms of bonds. Two different players in terms of bonds. So banks are majorly investors in short-term market, and pension funds are major investors. Pension funds and mutual funds are major investors in long-term market, long-term bond market. So the yield curve indicates the supply and demand of banking, and it indicates supply and demand of pension funds. Then there are two sides to a fixed income trading house, the sell side and the buy side. So the sell side is the investment dealer side. So firms divide fixed income duties into three roles: investment bankers, traders and sales representative. So sell side means they help to sell company's fixed income. So if I am a company, I am issuing fixed income, I'll contact a sell side firm to sell my offerings. So they help the issuer. Buy side is the retail and institutional client side, so they help the buyer. Most buy side institutional firms are divided into portfolio managers and traders. So investment bankers, traders and sales representative can be sell side. Portfolio managers and traders can be buy side. Traders are there both sides because traders help buyers also, they help sellers also. Settlement cycle, T-bills are settled in the same day and all other bonds, Government of Canada bonds, are settled in T+2 days. So trading, buying bonds through an investment dealer. So you can trade in firms with large institutional dealing desk. You can trade in firms without large institutional trading desk. Then there are inter-dealer brokers and there are non-electronic trades. So what is the advantage of trading in firms with institutional dealing desk vis-a-vis not trading in firm with institutional dealing desk? So institutional dealing desk means these firms have inventory, so they can furnish the demand of bond from their own inventory. So it is better to deal with firms that have institutional dealing desk. Then interdealer brokers are brokers that help dealers communicate with each other or trade with each other. Non-electronic trade is when you trade on phone, so all the phone calls are recorded. So even if you trade bonds on phone, you're liable to execute the deal. So they are treated as valid contracts. So whenever you trade, you get a trade ticket. So trade ticket is the confirmation of order. It means specification of counterparties, identification of bond. So bond number. So bonds committee on uniform security identification process. So this number. Nominal par and face value, price and yield is mentioned, settlement date is mentioned. Accrued interest will discuss it in a while, but that is mentioned, and the custodian is mentioned. So all these details are mentioned. Clearing and settlements for the bonds. So there are three types of bonds. Bearer bonds, so they do not bear any name of investor. Whoever holds it gets the rights to coupon. Register bonds are held with the name of the investor, so it is little safer than the bearer bonds. Both these are not traded much because most of the bonds are traded in book format now. So book format means they are traded in electronic format. Now this is important. Accrued interest is, let's say bond is a semi-annual bond and every 6 months it pays interest or coupons. Now I have held the bond for 6 months. I have held the bond for, let's say, 5 months out of 6, and I'm expecting to get the coupon after 1 month, but I sell the bond. Now the new buyer who is buying the bond from me gets the entire coupon for 6 months, though he is only going to held the bond for 1 month, because 5 months I was having that bond. So that is unfair to me. So what happens is, in this case, the buyer will pay the seller accrued interest or accrued interest. It means it will pay interest worth 5 months. So he only gets interest or the coupon worth 1 month, to be fair to me, because I was having the bond for 5 months, though I did not get any interest. The new bond holder gets it, the interest for entire 6 months. So he will pay back 5 months worth of interest, and you pay it when you buy the bond. So this is an example they have given in the textbook. So you purchase a 8% Government of Canada bond, which is due to mature on March 15, 2025. The principal is 200,000. You purchase the bond on 7th of May. The last coupon was paid in March. So you have to pay back the coupon from March to May. March 16th is therefore the first day of accrued interest, the one day after bond, the last payment date. The settlement date is 9th of May. The number of days in the transactions are as follows. So number of days will be 1 day after the coupon is paid, to the settlement date. Settlement date is May 9th. So 16 to 31, 16 days, 30 days and 9 days. So you have to pay him back face value multiplied by the coupon rate divided by 100 into the number of days, that is 55 divided by 365. So you have to pay him $2,410 when you buy the bond. Last part, the bond index funds can be used as a bond index funds are similar to what we have in stock market. So we have S&P 500, the Dow Jones. So you have bond indexes. So bond indexes can be used to gauge the performance of overall bond market as a performance measurement tool and to construct bond index funds. So example, FTSE TMX Canada Universe Bond Index Fund is an example. Now the important thing in this chapter, I'm just going to summarize it in a brief discussion. So things that you have to remember. So bond prices are inversely related to yields, YTM, right? It means if YTM increases, bond prices fall, and if YTM falls, bond prices increase. That is the first thing you have to remember. Next is sensitivity of bonds. Okay, so you have maturity, you have coupons, and you have duration. So sensitivity is high when the maturity is long, when the coupon rates are low. So lower the coupon, higher is the sensitivity, and when duration is high. Sensitivity is low when maturity is short, coupon rates are high, and duration is low. So what do you do when interest rate fall? When interest rate falls, you will buy. When interest rate falls, the bond prices go up. Inverse relation. So when interest rate falls, you want to make the most amount of money. So you will buy a long maturity bond, a low coupon bond, and a high duration bond. When interest rates rise, the bond is going to fall in value. So you are going to reduce your risk by buying a short-term bond, by buying a high coupon bond, and buying a low duration bond. So this chart is important. Okay, do remember it. The next concept was accrued interest or accrued interest. It is the amount the buyer pays to seller to compensate for the lost coupon. It is calculation. Important things: always calculate number of days from 1 day after the last coupon to the settlement date. So if settlement date is not given, it is 2 days after the buying date. Okay, these two things are important. So thank you. See you in the next recording.